Right now, while most people are completely asleep, one of the greatest wealth transfers in human history is unfolding in real time, and it is happening through a metal that fits in the palm of your hand, silver. And if you are holding it, do not let go, because what is coming is not a prediction anymore. It is a mathematical inevitability built on 5 consecutive years of data that Wall Street does not want you to see clearly. Since 2021, the global silver market has run in deficit for 5 consecutive years, with cumulative shortfalls of roughly 820 million ounces between 2021 and 2025, nearly equivalent to a full year of mine production. Let that land for just a moment. Nearly 1 full year of every mine on this planet operating at full capacity, gone, consumed, vanished into solar panels, electric vehicles, semiconductors, and the hands of people who understand what is happening. And the world produced zero net replacement. Zero. That is not a market anomaly. That is a structural collapse of supply happening in slow motion, and it is about to accelerate into something most financial analysts are not even calibrated to measure. In 2025 alone, global silver demand reached an estimated 1.24 billion ounces, while total supply, including mine production and recycling, only amounted to about 1.01 billion ounces, representing a deficit of over 230 million ounces, equivalent to the entire annual output of Mexico, the world's largest silver producer. Read that again. An entire country's worth of silver, Mexico, the single biggest silver-producing nation on earth, just wiped out in 1 year's shortfall. And this is not a temporary demand spike driven by speculators. Over 58% of total silver consumption now flows to industrial applications, with demand driven by solar panels, electric vehicles, and data centers. Demand that is largely price inelastic, because for manufacturers, silver is essential for its unmatched conductivity. Representing a small cost share in complex technologies, they will pay whatever the price is. They have no substitute. There is no plan B for silver in a solar cell. There is no aluminum version of a silver contact point in a high-voltage electric vehicle circuit. The engineers have already told the accountants, we use silver or we do not build it, period. Now let us talk about what is happening to the physical market, because this is where the story gets deeply serious. COMEX registered inventories have declined over 70% from their 2020 peak, dropping from 346 million ounces to just 82 million ounces. London Metal Exchange silver stocks have plunged to historic lows, Chinese inventories have reached decade lows, and borrowing costs spiked to 200% annualized during periods of acute tightness. 200% annualized lease rates. That is not a tight market. That is a market screaming that it cannot find metal. When it costs you 200% annually to borrow silver for 30 days, it means the physical silver is not there. It means institutions that sold paper promises of silver delivery are now scrambling, panicking, calling every vault in the world, trying to cover what they already sold. Fewer than 2% of precious metals futures contracts result in physical metal delivery. The remaining 98% undergo cash settlement or contract rollover, allowing the system to function with relatively modest physical inventory relative to outstanding paper obligations. For decades, this worked because nobody actually demanded the metal. That era is ending. Right now, when London ran short, bullion banks pulled actual silver off COMEX shelves and shipped it across the Atlantic, draining 29 million ounces in a single month. 29 million ounces in 30 days. The vaults of the world's most powerful commodity exchange drained by a transatlantic scramble for real, physical, touchable metal. And this is just the beginning, because China just changed the rules of the entire game. China reclassified silver as a strategic material, restricting exports, which has fragmented the global market and exacerbated supply shortages, effectively weaponizing silver supply in the same way oil and rare earths have been used in the past. China, which is the third largest silver producing nation and a massive refiner of global silver supply, just closed the door. And when that door closed, the silver market split into islands, Asia holding its metal, Europe scrambling, and North America draining COMEX at a pace that should be the headline on every financial news network on the planet. It is not, because those networks are owned by the same institutions that are short paper silver. The silver market is no longer a single unified price discovery mechanism. It has fractured into two distinct realities: a paper world trading on exchanges and a physical world where metal is vanishing. And when paper and physical diverge this dramatically, when the paper market says one price and the physical market charges a completely different premium, history tells us exactly what comes next. The paper price breaks. It breaks violently, it breaks upward, because eventually someone demands delivery. Eventually, an industrial buyer in Germany or South Korea or India says, I need 5 million ounces of physical silver next month for my solar panel factory, and the exchange says we do not have it. At that moment, price discovery moves from a computer algorithm in Chicago to the actual geology of the Earth's crust, and the Earth's crust is not generous with silver. Approximately 75 to 80% of silver production comes as byproduct from copper, zinc, and lead mining, meaning higher silver prices cannot stimulate production increases if base metal economics do not justify operations. You cannot build a new silver mine to solve this problem. Takes 7 to 10 years to permit, build, and bring a mine into production. The deficit you are living through right now will still be a deficit in 2031, even if every mining company on Earth broke ground on a new project tomorrow morning. Now let us zoom out and look at the monetary picture, because this is where $50,000 silver stops sounding outrageous and starts sounding like arithmetic. Currently, the U.S. government values its gold at $42.2022 per ounce, a price completely disconnected from real-world market value. Given the magnitude of the debt crisis, many analysts believe that revaluation would need to be much higher, perhaps $10,000 or even $138,000 per ounce, to meaningfully offset the national debt. We are 55 years into a monetary experiment that has never been successfully concluded in human history. Every fiat currency system that has ever existed has ended in one of two ways: either a managed return to hard asset backing or an unmanaged collapse into hyperinflation. There is no third option. There never has been. And the signals that we are approaching that terminal phase are everywhere if you know where to look. They have already told you what the plan is. They are just waiting for the politically optimal moment to execute it. Emerging market central banks are accumulating silver as a monetary and strategic asset. Russia moved first under Western sanctions. The Russian central bank started searching for assets that could withstand U.S. financial pressure, and silver became part of that strategy. Russia committed to a multi-year plan to accumulate over $500 million in silver reserves, the first major central bank to openly add silver to reserves in the modern era. Central banks are not buying silver by accident. They are buying silver because the people who design monetary systems understand that in a world where gold is too expensive and too scarce to serve as a transactional reserve for smaller economies, silver is the next logical tier. It is monetary metal. It has been monetary metal for 6,000 years of recorded human civilization. The 70-year experiment of pretending it is only an industrial commodity is ending in real time, right before your eyes. When the first domino falls among central banks, the others follow. They always have, because no central banker wants to be the last one holding fiat paper when the music stops. Let us talk about the gold to silver ratio because it is the most powerful valuation tool that most silver investors never use correctly. Silver still lags significantly, needing to move into the $170 to $100 per ounce range just to match gold's inflation-adjusted historical highs. And that is not the extraordinary scenario. That is the base case. Bank of America projected silver could reach between $135 and $300 per ounce in 2026 based on historical gold to silver ratio compression. Bank of America, not a fringe newsletter, not an anonymous blogger. Bank of America, $309 per ounce as a serious institutional price target for 2026. Goldman Sachs expects silver to average $85 to $100 per ounce in 2026, viewing it as the primary strategic metal of the green transition. Citi has issued a target of $110 for the second half of 2026, citing acute shortage of physical silver available for immediate industrial delivery. These are the conservative institutional estimates. The people who are actually closest to the physical market, the ones watching the vault levels, the lease rates, the delivery demands, they are whispering numbers that would make mainstream analysts choke on their coffee. The cumulative silver deficit since 2019 now tops 1.3 billion ounces. Independent metals research firms say the world is facing the deepest silver supply deficit ever on record, approaching 295 million ounces for 2025 once ETF flows are counted, the deepest in recorded history. And supply cannot respond because of the geological reality we already discussed. The deficit widens every single year. The inventories drain every single quarter. And the industrial demand side only grows because the green energy transition is not optional. It is mandated by governments representing billions of people, and every solar panel, every electric vehicle, every AI data center server stack requires silver. Solar alone is expected to nearly double silver demand between 2020 and 2030. By 2050, cumulative solar demand could equal 85 to 98% of today's known silver reserves. Let that number sit in your consciousness for a moment. Solar energy alone, just one sector, just one application, could consume nearly the entire known silver reserves of the planet within 25 years. Before we have even mined a single ounce for jewelry, for monetary investment, for electronics, for medicine, for water purification, for any of the hundreds of other applications silver serves. The math does not balance. It cannot balance. And when supply and demand cannot balance, price is the only mechanism that clears the market. Price goes to wherever it needs to go to balance the equation. And in this case, that number is incomprehensibly large by today's standards. Once physical delivery becomes the benchmark for price discovery, the traditional futures exchanges like COMEX may lose control of global pricing altogether, similar to what happened in lithium and rare earth markets when physical shortages emerged. We have already seen this movie. We watched lithium go from $6,000 per ton to $80,000 per ton in less than 3 years when the electric vehicle industry realized the supply was not there. We watched uranium sit ignored at $20 per pound for a decade and then launch to $106 in 18 months when utilities finally understood that existing mines could not fuel the reactors. Silver is next. Silver is the last great commodity that the paper market has been able to suppress below its true clearing price. And that suppression is ending because the vaults are empty, the deficits are compounding, and the industrial buyers have no substitute. The paper traders are running out of time, and the holders of physical silver are running out of patience. And that is a very, very powerful combination. This is your warning. This is your moment of clarity before the noise begins. The $50,000 prediction is not hyperbole. It is the logical terminal destination of a monetary system that has printed tens of trillions of units of currency while the supply of silver on this planet remains fixed by geology. Every dollar printed, every euro created, every yuan issued makes the silver in your hand more valuable in relative purchasing power terms. Every solar panel installed makes it more valuable in industrial demand terms. Every COMEX vault drain makes it more valuable in physical scarcity terms. Every central bank that adds silver to reserves makes it more valuable in monetary terms. These forces do not compete with each other. They compound each other. They reinforce each other. They stack on top of each other like tectonic plates grinding toward an earthquake that only the prepared will survive financially. The question is not whether silver will reprice. The question is whether you will own it when it does